Good morning, good afternoon, and for our viewers in Asia, good evening. I'm Peter de Vries, the Marketing Director at Asia Frontier Capital, and I would like to extend you a very warm welcome to our quarterly AFC Market Update webinar. Today with us on the call, we have Ruchir Desai, who is based in Hong Kong and co-manages the AFC Asia Frontier Fund, along with our CEO, Thomas Huber. Then Ahmed Tabakchali, the Chief Strategist of the AFC Iraq Fund, and who is normally based in Iraq and London, but is currently dialing in from Amman, Jordan. Then Scott Osheroff, the Chief Investment Officer of the AFC Uzbekistan Fund. Scott is currently based in Tashkent. And finally, Vicente Nguyen, the Chief Investment Officer of the AFC Vietnam Fund, who joins us from Ho Chi Minh City. 2022 continues to be a volatile and unpredictable year for investors. Besides the conflict in Ukraine dragging on, the US Fed has become much more hawkish in the past few months on the back of higher than expected inflation, while worries about a recession in developed markets continue to grow. A combination of all these events has had a profound impact on investor sentiment. Today, we will discuss the impact of these global events on Asian frontier markets as well as on our funds. Ruchir will first talk about the AFC Asia Frontier Fund, followed by a discussion about the AFC Iraq Fund, the AFC Uzbekistan Fund, and finally, the AFC Vietnam Fund. The webinar presentation will last for about 45 minutes, followed by 15 minutes question and answer session. We hope to make this webinar interactive, so please type in your questions in the Q&A box. You can click on the Q&A button at the bottom of your screen, and we will try to answer as many questions as we can fit in the available time. Now I will hand over to Ruchir to give you an update on the AFC Asia Frontier Fund. Ruchir, take it away.
Thank you, Peter, and welcome everyone to our second quarterly webinar on Asian frontier markets. And as Peter mentioned, I'll update you on the AFC Asia Frontier Fund. So what I'll do is probably walk you through some of the macro trends that have been affecting basically pretty much all the global economies and how it's impacting our markets. And then I'll probably talk about the structural trends that are still in place in our universe. And then I'll talk about some of the valuations in our markets as well as the outlook. So let's get started. Of course, inflation, I don't think I have to talk much about this. I think many of us must be personally feeling it at this point in time. We've seen inflation pick up pretty much everywhere across the world, especially since the war in Ukraine began. So it's become a global phenomenon. It's not just restricted to the US or Europe. It's pretty much in Asia and all parts of the world. And as this chart shows, inflation's picked up pretty much everywhere. And as the orange line on the chart shows you in the center, it's world consumer inflation. It's picked up, which reflects what I'm saying is that it's a global phenomenon at this point in time, especially the last probably 5 or 6 months. Having said that, we've been talking about high inflation. We expect higher inflation, entering into 2022. That's what we wrote in our review and outlook report in December last year. So it's not a surprise, but what is a surprise was the fact that there was a war in Ukraine, which really turned the tables on inflation. So if there was no war in Ukraine, I don't think we would have been talking about inflation in such a heavy fashion at this point in time. And of course, interest rates also, because of the high inflation and in general, the overheating of some of the economies, interest rates have picked up, especially now with the US Fed getting more aggressive and more hawkish in their comments, and also in their interest rate move. We just saw an interest rate move last night from the Fed, raising interest rates by 75 basis points. So it's about, the benchmark is at about 2.25% now. So clearly expectations from investors have moved up in terms of how hawkish or how aggressive the Fed is going to be. As this chart shows you, the maroon line is what the market expects in July. It's just earlier today, and this was when we spoke 3 months back, is the pinkish line in April 2022. So clearly expectations have moved up in terms of how aggressive the Fed is going to be in raising interest rates. Having said that, I think now the market, we're getting close to the end of the year by in a couple of months. I think there are only 2 or 3 more Fed meetings left. So the market is expecting some kind of interest rate dovishness, or at least interest rates speaking out of getting cut from next year, as this chart suggests. So I would say if there's some kind of, not negative, but if there's news about economic slow economic growth, earnings seeing a slowdown, unemployment kind of taking a bit of a hit, I think that's probably should be taken in a positive light, because at least that will give the Fed the confidence that things are cooling down and make them more dovish. What we don't need is inflation coming up higher than expectations for the next couple of months, like they've been in May and June, and the Fed, making investors more nervous with their hawkish comments. So hopefully, we are closer to the end in terms of the inflation and interest rate scenario, but let's see how it goes. I think next 2 months will be quite critical in terms of how inflation moves in the US. Having said that, the central banks in our universe have been very aggressive way before the Fed began raising rates in March of this year. So if you look at some of our markets, Pakistan has been very aggressive since September last year. This chart basically shows you the percentage, the basis point increase in benchmark interest rate so far in this calendar year. But Pakistan began raising in September of last year, so they've raised interest rates by I think almost 800 basis points in the last about 8 or 9 months. But of course, there were other issues. They have high inflation. They have a current account deficit, a weakening currency. But also Kazakhstan's raised interest rates by almost 500 basis points. Just raised interest rates by 50 basis points earlier this week. And in fact, Kazakhstan is one of the few countries which actually has an interest rate which is close to the level of inflation. Inflation is about 14.5% in Kazakhstan, and the benchmark interest rate is about 14.5%. But if you look further down the chart, many of the other Asian countries like India or Philippines or Malaysia, they've hardly been aggressive in raising interest rates. Of course, inflation is much lower in these markets, but they've been way less aggressive than the Fed has been. Fed has raised rates much higher than some of these markets. So I'm not saying they're behind the curve, but there could be more room for some of these markets to increase interest rates compared to our universe. And moving into 2023, if and when interest rates do peak out or inflation peaks out, I think our markets, central banks in our universe will be the first to cut. And that'll be very positive for investor sentiment. And in fact, just adding to that point, real interest rates in many of the other countries in Asia actually are quite negative. In India, benchmark interest rates are 4.9%, and inflation is coming up above 7%. Same is true for Indonesia, Thailand, and even Philippines. But that doesn't necessarily mean that's been good for markets. So, of course, these have been major headwinds this year, and it's been a very disappointing year across the board for frontier emerging markets and also developed markets. As this chart shows you, returns have been basically hit pretty bad. We are pretty much in a bear market now. And returns have been 15% negative or almost 30% negative in some of the other markets as well. One exception has been the Middle East because of the higher commodity prices. Jordan, you might wonder, Jordan doesn't export any oil, but they have a large reserves of potash and phosphate, which is in high demand right now, given the fact that Russia and Belarus were large producers of both potash and phosphate. And that supply has been restricted in the last few months because of sanctions and other supply issues because of the war. So Jordan's really benefiting a lot because of higher potash and phosphate prices. And we actually invested in Jordan in 2 companies which actually produce potash and phosphate. And they've done very well for us in the fund so far this year. So just moving on a bit, having said that, I mentioned that there's been higher commodity prices, higher inflation, high interest rates, but I mean, is there light at the end of the tunnel? Possible. Of course, natural gas prices have increased, as this chart shows you, in the last couple of weeks because of the tensions between the EU and Russia in terms of gas supplies. But if you look at the other energy, the other commodities in the energy basket, they peaked out after the war began. They've been correcting since then, especially crude oil from about $130 to now about $95. And even copper, aluminum, and coal have come off a bit. Having said that, oil at 95 still is pretty high for many of our markets because they're oil importers. So even the oil at 95 is not really a big benefit for them, because if oil remains at this price going into second half of 2022, you still have a 20% increase compared to the oil price, which was in the second half of 2021, $94 versus about $75 last year. So it's still a 25% increase or 30% increase. So that's still not really a big benefit. But if you move to 2023, then the base effect comes in, and then of course economies adapt to a high commodity price environment. So hopefully, if oil price doesn't go up more from here and remains at 94, 95, and goes down, I think 2023 you'll see some reduction in some of the pressures on the current account that many of the economies, especially now universe like Bangladesh, Pakistan, and Sri Lanka are facing. But I think more importantly, as this chart shows you, the food price, oil price is one part of the whole equation, but the food price is also impacting many many people in many parts of the world, especially in developing markets in Asia and also Asian countries. And I think this is key because low food price can actually help political stability. We've seen a lot of protests in Pakistan and Sri Lanka and also parts of Indonesia. So I think more than oil price, lower food price is something which is more critical. And I'm quite glad that food prices have come off a lot in the last couple of weeks or last couple of months. And that will be actually a big benefit for political stability in our markets moving on into 2023. Also, more broadly, the price of moving containers, this is the price index of the 40-foot container. It's come off significantly since the end of 2021 and also since the war began in Ukraine. So there is some kind of light at the end of the tunnel, as I mentioned. Some supply pressures are easing off, as this chart shows you, because people have been talking about supply chain issues and supply pressures. But this chart shows that the prices are coming off and easing off a bit. And in the US as well, let's see how it goes in terms of inflation next couple of months. But this is the suppliers delivery time index for the manufacturing sector. It's also has been coming down the last couple of months. So some bright spots as well in terms of the global economic environment for inflation and also interest rates. Having said that, of course, as we may all be aware that despite some of the supply chain issues easing off, despite some of the food and commodity prices coming off, the risk of recession has increased. Now, whether we'll go into a recession, it's a very technical term. But what I can say is that we'll definitely have slow economic growth in the developed world. That's pretty much a given in the US, in the UK, and also, of course, in the EU as well. And as we've seen from the IMF and the World Bank, they revised their GDP growth estimates for 2022 significantly, especially for the developed world in the last couple of weeks. Having said that, there is a very high chance of much slow economic growth in developed markets. But it's still not really had an impact on the estimates of some of these multilateral agencies like World Bank or IMF in terms of cutting GDP growth estimates for our universe. In fact, GDP growth estimates for our universe, as this table shows you, have been held pretty steady for many of our markets, not all, but many of our markets. So for example, the change to GDP growth estimates for Vietnam, there's hardly been any change. In fact, it was upgraded a bit for 2022 because they had a very strong second quarter of 2022 as the bullet point, second bullet point below shows you 7.7% GDP growth. It's a standout number. I don't think anyone else in the emerging markets, frontier markets, is showing such kind of growth at such a high base. And also Bangladesh, no change in GDP growth. They'll do about 6.5% GDP growth this year. And a country which is not many people talk about, or in fact people had negative expectations for a country like Georgia because it shares a border with Russia, has cultural links to both Russia and Ukraine. And many people expected them to have negative impact because of the war in Ukraine. In fact, when the war just broke out, we spoke to a couple of banks and all the banks expected negative to basically 0% GDP growth this year. But in the first 5 months of 2022, Georgia's GDP growth is 11.2%. And who would have thought that 4 or 5 months ago? But they've completely cracked it in terms of their GDP growth in the last couple of months. And I'll talk more about that later on. So this is just following up from my previous slide. So GDP growth estimates for our markets are still pretty attractive despite the downgrades that we've seen the last couple of weeks from IMF and the World Bank. Both Bangladesh and Vietnam will lead GDP growth in our universe, and this is pretty healthy and attractive GDP growth rates of almost 7%, both for Bangladesh and Vietnam. And this structural growth is not because of high commodity prices or some one-off events. This is structural growth because of demographics, because of supply chain moves, and also infrastructure investments. And in general, as the chart shows you, the second last bar, it shows you the GDP growth for our whole universe is almost 5%. That's pretty attractive compared to given what's going on in the global economy at this point in time. Having said that, yes, IMF we can expect some more cuts to GDP growth outlook once the IMF declares their October, GDP growth estimates again. But I don't see them cutting estimates for Bangladesh by 2% or 3%. At the most, from 7%, they'll do like 6.5, so 50 basis points. But 6.5% GDP growth is still very, very attractive. And Vietnam, in fact, I would not be surprised if they do 7% easily this year in GDP growth for 2022, because in the first half they're on 6.4, and in the second half of this year you have very low comparison compared to last year, because last year they were locked down for the second half of 2021. So I'm pretty sure, I'm pretty confident they'll be able to do 7% in 2022. Coming to some of the structural trends, moving on to some of the structural trends, coming on to Georgia, which I was talking about earlier in terms of GDP growth being extremely strong this year, and people expecting them to have a negative impact because of the war in Ukraine. They've actually benefited. And in fact, the tourism sector has been one of the biggest beneficiaries of the war in Ukraine. As this chart on the top left shows you, it shows you the tourism revenues for Georgia, and also the red line is their tourism revenues as a percent of pre-COVID levels, which is 2019. And they've almost gone back to 100% of their pre-COVID levels in terms of tourism revenues. And in fact, the month of June had the highest ever monthly tourism revenues ever for the country. So it just shows you how the country has benefited because of a lot of long-term visitors from Russia, from Belarus, and Ukraine moving into the country. And as the chart on the top right shows you, basically Russia, Belarus, and Ukraine now account for almost 40% of arrivals. I think before the war began, it was about 25, 26%. So clearly, they're benefiting a lot. And in fact, Georgia's tourism recovery is much stronger than the ASEAN peers. I mean, I was just seeing a report the other day that Singapore, despite opening up the borders, I think their arrivals have gone back to 29% of 2019 levels, but Georgia is about 52%. So they've done very well for themselves the last couple of months. And just another point on Georgia, I think over the last couple of months, there's been talk about some tensions between Kazakhstan and Russia because of the geopolitical issues because of Ukraine. Just a quick point on this is, as this image or chart on the top left shows you, currently Kazakhstan exports 80% of their crude oil through this pipeline called the Caspian Pipeline Consortium, or the CPC. The crude is of Kazakh origin, but the pipeline predominantly runs through Russia and ends in the Black Sea port on the Russian coast. So obviously Russia has a lot of leverage over Kazakhstan if and when they want to cut the tap off in terms of letting the crude oil flow freely. And that's actually already happened. Since the war began, there have been 3 occasions when Russia has come up with lame excuses of cutting off Kazakhstan's oil export from this pipeline. And of course, Kazakhstan knows it's at a disadvantage. So in the long term, they have to find other supply routes for their crude oil, and they cannot be subject to this kind of domination from Russia for their oil supplies or oil exports. And as the image on the right shows you, there's already a pipeline in place on the Caspian Sea, and basically Kazakhstan gets their oil from the Caspian Sea as well. But this pipeline runs from Azerbaijan to Georgia and into Turkey, and that oil basically ships to Europe. Coincidentally, most of Kazakhstan's oil gets shipped to Europe as well, but via the Black Sea. So this could be a long-term solution for the country. It'll take time. It's not going to happen in 6 months or 1 year. You still have to expand capacity of the pipeline, and you have to ship the product from Kazakhstan to Azerbaijan. So there's some additional costs involved. But clearly, Kazakhstan is already talking about this. The president was in Turkey and a couple of weeks ago, and clearly this is something that they want to focus on. And Georgia obviously will benefit from the transit routes of this oil running through the country. So I think here also Georgia is a bit of a beneficiary as well. And this I've spoken about before in my presentation. Clearly, Bangladesh and Vietnam are benefiting from supply chain diversion. In fact, Bangladesh and Vietnam are now close number 2 in terms of garment exports globally. As the chart on the top left shows you, they've gained market share in the last decade. And as the chart on the top right shows you, Vietnam's FDI has been very consistent even despite the pandemic. It's basically remained at about 6% of GDP, which it was even before the pandemic began. And of course, there are worries about recession right now, there's slower economic growth in the US and also in Europe. But exports as the chart on the top left shows you, monthly exports to the US from Vietnam, they were pre-pandemic at about $4 billion a month. And now they've gone to about $9 or $10 billion a month. So they've basically doubled in the last 2 years. So it just shows you how important Vietnam has become for the US as a supply partner. So I don't see, even if there's a slowdown in US or a recession, I don't see this really impacting export growth from Vietnam. And also Bangladesh's exports have been doing well, as the chart on the top right shows you. They just crossed $50 billion in exports in the last 12 months. So a pretty big achievement for them. And just a quick point on infrastructure, despite all the issues that the global economy is facing in terms of high commodity prices, countries still continue to invest in infrastructure. Bangladesh just built up the biggest road and rail bridge, which is about 6 kilometers long across the river. That would be a game changer for the economy because of the way some of the transport is moved. And also the picture on the chart on the right shows you the new airport being built about an hour from Ho Chi Minh City. It's going to really increase capacity significantly for the tourism industry as well. Just on a top-down basis, the macro is something which is very important. I think if you look at debt to GDP, that is some of the issue. The biggest issue in the last year or so has been the debt for many countries, and that's why many countries are facing issues now. But on a top-down basis, some of these countries in our universe have very low debt levels. So I think they should be able to survive this tough macro environment at this point in time. Just coming to the valuations and the bottom up, if you look at the valuations of some of our top picks in our portfolio, these are all blue chip companies. They've been around for many years, but the valuations just speak for themselves, as the second last column shows you. Most of these companies trade at 10 times or less. So you're getting significantly low valuations for blue chip companies which have grown earnings, on a cumulative basis by 10 to 15%. Of course, this year earnings could be a bit weak because of slower economic growth in general. But overall, you're getting extremely attractive valuations. These companies will stick around. They'll handle the pandemic pretty well. They'll handle the tough times, and I think they should recover going forward as well. And sticking to valuations, which I was mentioning, the lower valuations for our portfolio companies is reflected in our portfolio as well. The PE ratio of the AFC Asia Frontier Fund is basically at its all-time low at 8 times. It doesn't get cheaper than this. You don't get such attractive assets now. So I would say, in general, this is the time to start looking at frontier and emerging markets, because everything has been hit so badly. Everyone has become so pessimistic. But even if you get a P multiple expansion for the fund of some of the stocks that you own from 8 times to 10 times, you get a 25% return. So it just shows you the upside that is available in our markets. And as earnings recover, that return can sustain as well going forward. And also this shows you the discount between the frontier markets in Asia versus the S&P. It's the lowest it's been since 2015. So as I was saying, it doesn't get cheaper than this. So as I said earlier as well, this is the time to start looking at frontier and emerging markets. And this is just a quick slide on our fundamentals. Despite the issues, earnings CAGR is about more than 20% for our portfolio, a strong return on equity, and even the annualized volatility for a fund is less than 11%, despite us being in frontier markets, which are expected to be volatile and risky. And this is just a quick snapshot of our country and sector allocation. Just a quick word on our sector allocation. Most of the stocks or sectors you see over here are basically consumption focused, because we believe in the future of our markets in terms of higher consumption. Could be financial services or consumer discretionary or telecom services. And I would just wrap up by saying that, yes, it's going to be a bit of a volatile time for global markets. It's already been a volatile time, and it'll be a bit more volatile for the next couple of months until investors believe that the US Fed the US Fed becomes less hawkish and people think inflation has peaked out. But I think now the valuations have been discounted a lot. It discounts a lot of the bad news. So actually, I would stick my neck out and say the next 12 to 18 months returns for the fund and also Asian frontier markets will be positive. So if you're looking to make a return, this is not the time to sell. This is the time to get into frontier and emerging markets. And like I said, I'll stick my neck out and say there'll be positive returns in 12 to 18 months. So that's it from me. I'll hand it over now to Ahmed Tabakchali, who will talk to you about the AFC Iraq Fund. Thank you.
Hello, thank you, Usher. Hello, everyone, and I would say good morning, good afternoon, and good evening to all those who are attending. Okay, now I think the interesting thing is what we heard earlier today so far. My colleagues telling you that it's been a very hard year. 2022 is a very tough year. We have the war in Ukraine and what they've done to commodity prices, but also that comes on the back of the tough dislocations that happened after the world recovery last year. Now, however, I look at this and I hear all these news, and as an investor in the AFC Iraq Fund and as an Iraqi who's seen this, the question comes back and says, so what, in a way? And I don't mean in a flippant way, but Iraq is one country that every kind of conflict that you come across, every kind of thing that you hear in terms of uncertainty, what does it mean for the economies? What does it mean for market? What does it mean for companies in this environment? Iraq has been through this, has been in fact through 5 years of that. As a reminder for everyone, the country almost was taken over, or a third of the country was taken over by ISIS in 2014, crash in oil prices, the country was falling apart. And yet our companies not only have survived, but they've learned to deal with one of the toughest environments that you can come across in any way. So this current environment is a boon in a way for Iraq, or if not the word boon, maybe it's the proper phrases say that it's actually a very easy market to deal with if you are investing in Iraq. I'm going to go over two things. First of all, the first slide will cover the fundamentals, and the second one will cover the technicals. So the fundamentals, basically, as people might know, Iraq is extremely leveraged to oil prices. That works well and bad for us. Currently, it works incredibly well for us, and there is always a link between oil prices and demand for oil, and that's very much linked to the world recovery. However, I do believe that over the last few years, this thing has changed, or let me rephrase, it has changed post the invasion of Ukraine, in the sense that energy security is now a much bigger issue than it was elsewhere, and also it will change the dynamics of oil prices. Now, I've included here Brent future contracts on the right-hand side, the top chart on the right-hand side, and they're basically reflecting what the market was seeing at various points in time. The line at the bottom, the gray line, which I hope you can see it, these were the expectations at the end of last year. And that's what the expectations were. The red line are the expectation that almost happened immediately after the invasion of Ukraine. And there was this massive fear that we would lose Russian oil supplies, which in fact we haven't. The reason why I've included those is to show you as well the yellow line, which basically shows you the expectations that happened pretty much almost 2 weeks ago, when it was quite clear that the world is going to be entering into a sort of a synchronized recession, or at least I would say, and I should correct myself as well and say it's the OECD, the developed world, that will see that. However, since then, the fundamentals of the oil market, i.e. how tight the oil market is, have reasserted themselves, and that's where you see the expectations in the green line. So the thing is, I would believe over the next few years, I'm not sure it will go all the way to 2029, but at least between now and 26, that these kind of levels will prevail. And that is incredibly transformative for Iraq. We were bullish last year when we looked at when the recovering oil prices and the gray line was in force. The current prices are incredibly transformative for Iraq, and Iraq's leverage to oil prices reflects that incredibly. So to give an idea, if oil prices were to average $100, or Brent were to average $100 this year and $90 this year, by the way, these are lower than market expectation, but if they were, Iraq's oil export would be something like $117 billion this year, and something like $100 billion next year if oil prices are 90. That, to give you the sense, that's versus a very expansionary budget that we'll have this year of about 92 billion. So we have incredible upside to that. Obviously, there's going to be downside to expectations, as always. Iraq is leveraged to oil prices. Every dollar move in oil prices is reflected in about $1 billion in oil sales. So every time there's some change, would be positive for us. The interesting thing is that one of the fundamentals are very interesting for Iraq, and they're quite different from many countries. Unlike many countries in the world whereby price rises are prompting central bank to raise interest rates and also to slow down the economy. You have interest rates that will slow down the economy on top of price rises that are slowing down the economy. And governments, all of them, are having one or the other restrictive policies. Iraq, if anything, have an expansionary capability precisely because of oil prices. So this year, although we have issues with government formation, however, our parliament has approved a supplementary budget of adding something like 23% of spending over last year. The interesting thing in this is that it will be coming in. It was approved in June. So all that 23% will happen around between now and year end, which should inject significant liquidity into the market. To give an idea of how transformative this whole thing is for Iraq and for the government to pursue expansionary policies, you can see the bottom chart, which is the oil export sales, and compare them to where they were last year. So, if the current levels persist, and here I'm forecasting as well $100 for 2022 average, $90 for 2023, and this is what you can see. The red line is the the actuals, while the green are projected. So again, it should be transformative in the government's ability to shield the population from the effects of higher food prices and so forth, and to pursue expansionist policies, which will eventually mean increased liquidity, increased activity in the market. If I can have a second slide, please. Second slide is really where it's becoming very interesting. One of the really crucial things of investing in frontier markets, and very much almost like a pre-frontier market like Iraq, is not only the fundamentals you have to understand, but you have to understand the peculiarities of investing in these markets, which are mostly shallow, illiquid, and so therefore they tend to exaggerate price movements, and they don't always reflect the fundamentals. There's always going to be a disconnect between the fundamentals and technical, and I'll explain that in a minute. Iraq, unlike many other markets, two charts can show you this. One, the bottom chart shows you our benchmark with the RSISX USD index in blue, and the other markets. You can see every other market had enjoyed a recovery, one or the other. Even their declines are declines of very high levels. They're still much higher than they were at a few years ago. The picture is exactly the opposite for Iraq. We've emerged from a 5-year brutal bear market that saw the index down something like over 70% between highs and lows. And that's where the top chart can show you, where you can see year-over-year declines. And right now, the market is beginning in a very tentative uptrend that is taking place. Now, the interesting thing, what I mean by the technicality is, in frontier markets, and especially like Iraq, extreme illiquidity translates basically into a few sellers for various reasons can affect the stock price. So in many cases, you see a company with over $200 million market cap down by 10, 15% because of sales of $200,000 or $300,000 and what have you. The thing is, this is really where the opportunities in investing in the frontier market exist. And that's part of the reasons why at the FC Iraq Fund, we look at these things in the sense that the name of the game for us is to acquire these assets that otherwise, without the technicalities, without the peculiarities of an illiquid market, it would be very difficult to buy these illiquid stocks. I mean, they're liquid enough for Iraq, but illiquid in general. I have to say that. So in a sense, that's where we get the opportunity. In a sense, we can buy assets at very discounted prices because it doesn't take much for sellers, unlike a normal period of time when we have to chase prices higher. All in all, I would say we are at the beginning of a recovery. The current weakness in the market, where the index is down over 5.5%, we're down about 9.3. I believe that presents a unique buying opportunity into this wonderful story I believe is taking place. I think with that, I'll say thank you very much. And I think I've pretty much used my time. Thank you for that. And I will leave you with my colleague, Scott, to take over on the Uzbekistan Fund.
Thank you, Ahmed. There we go. Hi, everyone. So as I mentioned on our last call, Uzbekistan remains a relative island of stability in a world where you're seeing rising economic and social volatility, largely due to rising commodity prices, which I believe are in a secular or structural shortage, which puts the country in a very good position as it's largely self-sufficient in food and energy. Next slide, please. So the country has been doing quite well. In the first half of the year, statistics have been positive. GDP came in at 5.4%, and the central bank recently increased their full year 2022 GDP estimate from 3.5% to 4.5%, up to 5 to 5.5%. Meanwhile, inflation remains largely in check, around 11%. Ironically, at the same time as since June of this year up until the present, the central bank has lowered interest rates by the policy rate by 200 basis points to 15%. Meanwhile, the rest of the world is seeing inflation rise up into the high single digits, in some cases low double digits, and everyone is in a tightening cycle. So Uzbekistan is in a pretty good situation in that regard. Remittances surged 96% during the first half, and exports were up 40.5%, outpacing imports, which were up 27%. typically imports exceed exports, but the reason that exports were so robust in the first half is because the central bank sold a large amount of gold, which they do from time to time, being that the country has about 26 billion of gold in the bank. So roughly half of their exports in the first half were gold related. And then on the capital markets, news has been quiet, but nonetheless, things are happening. So a few things to discuss briefly. We've just entered the beginning of Q2 earnings season, and we have a materials company, glass manufacturer, which reported earnings growth of 600% year over year. And then we have a chemical company producing white spirits, which saw earnings grow 22%. And then the fund's largest holding is Kizikun Cement, the largest cement company in the country. Their earnings were down 10%, though we're actually very pleased with the fact that earnings are only down 10%, because in the first half of this year, the country as a whole experienced a gas shortage, and the entire cement industry was hit. So first quarter earnings were not good, and that carried over a bit into the second quarter. But nonetheless, earnings picked back up, and we expect them to be stable or experience growth throughout the rest of the year, as Kizilkum Cement is in the process of inaugurating their fourth production line, which is about 1.1 million tons. Further, we exited the position during the month. There's a company minority position that was privatized by the state to a private owner who wants to take the company private and delist it from the stock exchange. So we got out at a 27% gain. And then also, I believe on Tuesday of this week, the government announced that our largest holding, Kizilkum is our second. Uzmet Kombinat, steel company in Uzbekistan, is in the process of preparing to do a rights offering to the tune of $170 to $180 million, of which we'll be participating in. Next slide, please. So I haven't talked about this before in any of our monthly updates because there hasn't been much to talk about. But President Amir Ziyoyev, as part of his campaign, his election campaign, when he got elected for his second term in October of last year, was constitutional reform. And we've talked about before that a lot of the easy reforms have been done during his first term, lifting FX controls and whatnot. And now the hard things need to be done. And constitutional reform was part of his election campaign, and there have been a handful of roundtables and discussions on the subject since. So it really hasn't been a surprise that this was coming, but the proposed changes are not finalized yet. We'll probably get a short list of proposed changes in the fourth quarter of this year. Some of them include transitioning the political paradigm from one of putting the state first to putting individuals first. So removing that Soviet mindset, improving human rights protections, and also, which we think is one of the biggest proposed changes, would be the privatization of land. If you look at any country that has a large middle class, there's typically strong land rights and protections and the ability to own land freehold. So if that comes with this constitutional reform, that'll be huge. And the government actually in March of 2020 passed legislation allowing for the privatization of land, but according to the Constitution, it's still illegal. So we'll be watching that closely. And it's worth keeping in mind that the vast majority of the companies that we own, listed companies, all have a large portfolio of real estate. So arguably, you have the privatization of land and the ability to develop it and do a handful of things with it and monetize it. You're potentially looking at a lot of companies in our portfolio where the land parcels or the land banks are worth more than the operating businesses themselves. Now, I'm sure that a lot of you probably saw in the news in early July news about unrest in the west of the country. And this occurred in the far west of the country in a region called Karakalpakstan, which represents about 30% of the country's landmass. And there's an ethnic minority group there called the Karakalpaks. So in the Constitution, Karakalpakstan has the right to hold a referendum to secede from Uzbekistan and to eliminate the ability for them to hold a referendum. This caused unrest in the region. But nonetheless, Karakalpak only represent about 30% of the population there. So it's highly unlikely that any referendum would ever have succeeded. It's more or less a formality. But nonetheless, there was some unrest on the 1st and 2nd of July, lasted about 36 hours. I was in Tashkent. It was business as usual in the rest of the country, except for that state, that region. And then the president went to Karakalpak on, I believe, the 2nd and 3rd, said that they would not remove that clause from the constitution. And at the same time, in order to quell the violence that was there, they put in a state of emergency from the 3rd of July, which was supposed to last a month, but it actually got shortened and was lifted on the 21st of July. So things are slowly returning to normal. And it's unfortunate the way it was handled, but nonetheless, looking at the fact that it was really a formality and perhaps wasn't communicated as well as it should have been, there was some bad press, and unfortunately, it was a rather nasty incident. But nonetheless, it's part of what happens in a young developing country. So hopefully the government has learned from it and will handle other instances in a better manner. But nonetheless, we're really excited about the potential for constitutional changes, which should help to propel the country in the right direction over the next coming years. So with that, I'll hand it over to Vicente Nguyen, who will be discussing our Vietnam Fund.
So thank you very much, Scott. Good morning, good afternoon, good evening, everyone. So maybe we are concerning about US or Europe story when the high inflation will go over there and the possible recessions. But in Vietnam, we have a completely different story. So in Vietnam, you can see that a very high GDP growth in the second quarter. So in the second quarter, we have the GDP growth of 7.7%, and this is the highest level in the last 10 years. And not about inflation, okay? So in other countries, inflation is really a big issue, but in Vietnam, the inflation is still under control. At the end of June, the inflation in Vietnam is only 2.44%, compared to the target of the government is 4% for a year. So it means we still have a far way to reach the target. So I think that the inflation in Vietnam is still under control and we can manage it. So if you look at this chart, you can see that most of the key factors of the economy really have a very impressive improvement. Industrial production is very well, nearly 9% and nearly 10%. And particular, the retail sales is increased 19.5% because after the COVID-19 ease and the government removed all restrictions, so economy activity really come back and people started to spend money. So retail coming back and have very impressive growth. And this is very important for a country with 100 million people here. In terms of export, we can see that we also have very high growth in terms of export, 21% in the second quarter, regardless of the slowdown of US or Europe. But because of China still keep its zero COVID policy, so we really benefit from this. FDI, we have very stable growth. So 9% in the second quarter is proof that Vietnam is continue to be the destination of investors all over the world. The next, please, Peter. So we have the fact that GDP growth is up. Actually, the listed enterprise earning also up. In the first quarter, the earning growth reached 25%. The only thing is the index is getting down, 21% in terms of US daily term year to date, because the local individual investor in Vietnam, they dominate the markets with 90% daily trading volume. So they have very limited knowledge and experience, and they started to sell off whenever they saw the sell off in US market. So a lot of investors, they stay up at night just to follow the US market, and then they will react in the next morning in Vietnam. So we have the fact that everything, the fundamental base is going up and the price is getting down. So this is really create opportunities. A reason why you can see that the PE next year for in 2023, the estimated PE is only 9.5. This is the completely low valuation. So I think this is a good timing to buy, or at least it's not a right time to sell anything, because this is the bottom and the market can recover very soon, and we do not know when. So the next, please, Peter. So the opportunity is existing, but how AFC Vietnam Fund can capture this opportunity? So if you look at our performance in the long term since inception, we outperformed the markets quite well. And in the first half of this year, our fund also beat the market when we down around 10% only, compared to 21% of the index in US dollar term. So I think that we can capture opportunities based on how we allocate our portfolio. So as the first slide, I just mentioned that the retail sales went up aggressively because of the economy activity really returned. So the reason why we allocate quite a lot our portfolio into consumption sector. So when the economy activity revives, it will support very strongly the consumption companies. For example, in our top 10, we have a company with the ticker EVE. So the first quarter profit of this company went up 226%. And they are right now one of the top 10 in our portfolio. Or even we also invested in tourism company. So for example, this afternoon, one of our tourism position in our portfolio just reported the net profit in the second quarter increased 13 times, and it's come back the normal level before the COVID. So this shows that the reason why we allocate our portfolio in consumptions, because we think that when the economy comes back, those companies will benefit a lot. Another sector we also allocate more is food and government exporting. As I already said in the first slide, you can see that when the price up everywhere and over the world, it helps Vietnam to get benefit from this. We sell our food like seafood or rice or even coffee, because we are one of the largest agriculture product exported over the world. And we also export a lot of clothes. So for example, in our portfolio, we have a seafood company. So in the first quarter, the profits of this company increased 260%. And right now it's in our top 10 of our portfolio. Another company is a government company. This is the largest government clothes exporter in Vietnam. And in the first quarter, the profits of this company also increased 400%. And right now it's in our top 10 portfolio as well. And of course, in the volatility situation right now, we also allocate our fund in insurance sector, because when the interest rates increase, insurance company will benefit a lot, because they keep a lot of cash at the bank, and they will have really much interest from the bank. And in our portfolio, for example, the largest position, ABI, is a small scale, middle scale insurance company. And the market cap of this company is only 80 million, but the cash in the bank that this company is keeping is 120 million. This means 50% more than its market cap. And the company doesn't have any debt at all. So you can see how the valuation of this company is, how attractive is that. Besides those three sectors, we also allocate into some stock that we see that its earning is growing up aggressively, but the stock price getting down just because of the sell-off of a local investor. For example, recently we just add another retail bank. So this bank reported its net profit in the second quarter with a jump of 94%, but the stock price getting down 50% from the peak in the last 12 months. And you can imagine that this bank is traded at PP1 and the PE is only 3.9. The reason why we added this bank recently. So with this, our portfolio allocation, we think that we can capture this opportunity in the next 6 months of this year. So thank you very much. So I hand over to Peter.
Thank you. Thank you, Vicente. Thank you for these interesting comments, all of you gentlemen. We have now come to the Q&A section. We've received some questions already, and I welcome you to type any further questions you have for our contributors in the Q&A box. You can click on the Q&A button at the bottom of your screen. With the recent challenges and volatility, this first question that I see here is a very relevant question. This is about the right time to buy. Is now a good time to buy, or is it better to wait for better entry levels? And why? So, Ruchir, would you like to give this a shot?
Yeah, sure. Thanks, Peter. That's a pretty good question in terms of when is it a good time to buy? Well, I guess you can't really time the market all the time, is it? I guess so. You really have to take a call on where you think the bottom is, or how the things are going to shape out the next 12 or 18 months. But I think clearly the way the markets have performed over the last, probably especially this year, and valuations have taken a beating. I think what I'm trying to say is that you don't have to go on all in right now, but clearly this is a time to start looking at the markets from a longer term view, from a 12 to 18 month view. And I think next few months, as I mentioned in my key points as well, the next few months will be quite volatile. So you'll get these opportunities to start looking at investing some of your capital to equity markets in frontier and emerging markets over the next probably 1 or 2 quarters. So valuations have been discounted heavily. There's going to be some uncertainty, but the markets are forward looking. So you cannot wait till everything is rosy and the Fed starts cutting interest rates and GDP growth starts picking up back in the US. I think by that time you missed the boat. So you cannot wait for things to get rosy and wait till second half of 2023 and everything is fine. Oil prices back to $85, $90. Interest rates start getting cut. By then you've already missed the boat, in my opinion, or in my humble opinion. So I guess the next 3 or 4 months or next 6 months, you'll get the opportunity to start investing, and you should take those risks at this point in time.
Thank you, Ruchir. Scott, could you add to that maybe in terms of the special situation that Uzbekistan is in? So in relation to Uzbekistan, is now a good time to buy, or is it better to wait for better entry levels? Scott,
I think the entry levels are fine, but in terms of timing, the big catalyst for the market here is going to be the passing of the new capital markets legislation, which, as we've discussed before, is expected sometime in Q4 or hopefully at the latest Q1 of next year. And you have this privatization pipeline, which is, we're expected to have a few privatizations this year, but I really want to see that legislation be passed to make it much easier for especially foreign investors, but also local investors to open up brokerage accounts, to put capital to work, so you have these privatizations be successful. So the timeline for that is looking out sometime over the next 6 months. We'd hope to see news on that front.
Thank you, Scott. Got a question for Vicente. The insurer you mentioned that has only 18 million market cap, 100 million cash and no debt. How about the float and insurance liabilities?
So thank you very much. So this bank is a subsidiary of the largest state-owned, is also the largest bank in Vietnam, Agriculture Bank. So right now, Agriculture Bank keeps 31% and 49% is the floating on the market. Regarding to the question, how many percent is the insurance liability? So I'm not sure that I understand what you mean, but in Vietnam we call it insurance provision. So it means they will have a fund to pay out whenever the risk happens. So according to this term, the total amount of this company is 78 million. 78 million. And I mentioned again, the cash level is not 100 million, it's 120 million. And insurance liability maybe is the term you mentioned is 78 million. 78 million.
Okay, thank you, Vicente. Question for Ruchir. Please give us your thoughts on Sri Lanka. Are you looking to get more involved now or hold off a bit? Which, if any, company sectors are you looking to get involved in first, and which would you hold back on?
Yeah, it's a good question. But Sri Lanka has gone through a lot. Markets actually quite a bit, so one would probably get tempted to look at this point in time. But yeah, maybe from a stock market perspective, it's probably bottomed out. But I don't see any major trigger in terms of having a sustained rally of 25-30% over the next, say, 12 or 15 months. Primarily because of the fact that politically they're still, I mean, they have a new president and new prime minister, but I don't see how that's going to be more political, how that's going to add to political stability, because at the end of the day, they're still very closely linked to the previous president in some way or the other. And that could lead to early elections as well at some point in the next probably 18 months. Second is the IMF deal is not through. They need the funds and very badly. And that's still some time away. I don't expect an IMF deal to be through at least by the end of this year, or those funds to come through at least by the end of this year. And even once they get the funds, or to get those funds, they will take some very tough measures, and they're going to pass a budget, I think next month, where they will raise taxes. That's only going to hurt the consumer even more, or the corporates even more in terms of earnings growth. So I don't see any triggers in terms of earnings or consumer spending. In fact, it could also lead to more protests, because the consumers anyway so squeezed because of the lack of food and fuel, and now you are putting more pressure on the common man in terms of taxing them more. So I won't be surprised if there's still some more social instability as well in Sri Lanka. So I would wait for the year to pass, and then once the IMF deal is through, once I get some more clarity on politics, maybe then one can look at it. Having said, and probably from a trading perspective, yes, there's an opportunity, but I would also like to say that from a long-term view, structurally, I mean, the country needs to revamp completely in terms of the political structure, because whoever's in power right now, or who could be in power going forward, they need someone dynamic to turn the country around. And I don't see anyone dynamic enough at this point in time. Maybe I'm just being a bit honest, but they need someone dynamic to turn the country around and take it forward from a long-term structural view. So yes, from that perspective, maybe the trading opportunity after 6 or 7 months, but long-term, I have my doubts at this point in time.
Okay, thanks. Another question for you, Ruchir. What are your views on Pakistan? Are you looking to increase exposure given attractive valuations?
Yeah, Pakistan's another case right now where valuations are quite depressed. But again, like Sri Lanka, a bit of lack of clarity over there in terms of politics. You have a government which is in power, and there's pressure on them to call for early elections. So you don't know which way it could go there. And in any case, there's going to be elections next year as well. So in any, it's not just linked to Pakistan, but any developing market which is going to election cycle, markets are always jittery and a bit uncertain. And further to that, I don't see any earnings recovery in Pakistan, at least for the next 2 or 3 quarters. So selectively, yes, but not having an overweight position. I mean, I don't think Pakistan's story is attractive enough at this point in time to go from 7% to 17 or 20%. Has not become so attractive, because over here also you have structural issues, right? How do you give confidence to the investors or the investor community if a prime minister cannot complete 5 years in power. I mean, after 4 years, again, we'll be saying, oh yeah, it's a great story now, it's so cheap. But sitting here in 2026, we'll be back again to square one. That's exactly what's happened the last decade, basically. And you've gone back to square one. You've gone back to a current account deficit, which you had in 2018. You have to go back to the IMF again. So how do you build investor confidence to make it about? That's what I'm coming back to Sri Lanka and Pakistan again, from a structural growth, from a structural story. Yes, valuations are really attractive, but you're not building up a structural story over here. So investors will come in at 5 times PE, and they'll exit at 8 times once the next election cycle is in place, or once your current account deficit goes from -1% to -5%. But that's a continuous cycle that we're seeing in Pakistan. That's a bit of a dampener in terms of a structural story there. But yes, the next couple of months, you can buy a few stocks. But like I said, I don't see Pakistan becoming an overweight story until they get their top down right.
Okay, thank you, Ruchir. Well, then we've run out of time. We've come to the end of the webinar, and we will answer the remaining questions offline. I hope this webinar has been useful to you, and would like to thank you for your attention and look forward to seeing you in the next webinar in October. If further questions come up, please let us know. We're happy to take your questions separately, or happy to set up a call with any of our fund managers to talk about these in more detail. If you'd like to take advantage of the attractive valuations of our funds at the time, I'd be happy to help you with the subscription process. I wish you a wonderful day for our participants in the Western Hemisphere and in Europe, and a good night to the participants in Asia. Goodbye.
Thank you. Goodbye. Bye-bye.
Thank you.
Thank you all. Goodbye.
Thank you.